Look me in the eyes. You have been lied to. For decades, every financial guru, Wall Street suit, and YouTube expert has brainwashed you into believing the exact same thing. But what if their golden advice is actually a trap? They've told you the health savings account, the HSA, is the ultimate, untouchable holy grail of retirement planning. They preached the triple tax advantage. They told you to max it out and never touch it. And honestly, they were dead right up until the exact second you turn 65. At 65, your HSA stops being a wealth-building machine and quietly mutates into a financial landmine. If you don't know the exact sequence of how the IRS and the Social Security Administration communicate, spoiler alert, they don't. And they weaponize that silence against you. You are going to trigger a catastrophic tax trap. I'm not talking about a slap on the wrist or a tiny penalty fee. I am talking about a systemic domino effect chain reaction. We're talking about a mistake that literally annihilates your Social Security checks. It starts with one simple health savings error, bleeds into your Medicare premiums, and ends with the IRS legally seizing a massive chunk of your life savings under the new Secure Act 2.0. Sounds like a bad movie plot, right? I really wish it was. My name is Your Name. And in this masterclass, I am deconstructing the exact mechanics of this hidden government trap. I'll show you how millions of Americans are walking blindly into the crosshairs. But more importantly, I'm handing you the exact legal cheat codes to beat them. I'm giving you the specific IRS forms, the exact legal codes, and the precise chronological sequence to bulletproof your retirement. Put your phone on silent. Grab a pen. Do not skip a single second, because missing one step makes the rescue plan backfire completely. Let's get straight into it. To truly understand how lethal this trap is, you need to see it play out in real life. I want you to meet a guy. Let's call him Richard. Richard is about to make a massive mistake you might be making right now. Richard is 66 years old. He's a sharp guy, an executive who played by the rules his entire life. When Richard hit 65, he felt on top of the world. He was still working full-time, and he had a retirement game plan that made perfect logical sense. He was covered by a high-deductible health plan through his employer. So he thought to himself, I'm going to delay my Medicare. I'm going to delay my Social Security. I'll grind it out one more year. I'll keep maxing out my HSA to build up that tax-free medical war chest. It's the American dream of responsible saving, right? You'd probably do the exact same thing. But here is where the story takes a massive nosedive. At age 66 and a half, Richard hangs up the cleats. He finally decides it's time to cash in and enjoy those golden years. He retires, grabs a cup of coffee, goes online, and logs into the Social Security portal. He fills out the application for his well-earned benefits, smiles, and clicks the submit button. He thinks he just crossed the finish line, but did he really? Not even close. What Richard doesn't know, and what nobody bothered to warn him about, is that the exact moment his finger clicked submit on that application, he didn't just ask for an income check. He unknowingly pulled the pin on a massive financial grenade. By simply hitting submit, Richard silently triggered a hidden administrative protocol deep inside the federal government. A protocol designed to ruthlessly dismantle the financial safety net he spent 40 years building. And the craziest part? He committed a federal offense without doing anything wrong. Richard just made an innocent, logical mistake that is going to cost him tens of thousands of dollars in compounding phantom taxes and slashed benefits. It's absolutely brutal. Want to know exactly what happened under the hood of that government website? In just a moment, I'm going to pull back the curtain on the exact government manual that trapped him, so you don't step on the exact same landmine. Trust me, you are going to want to write this next part down, because what happens next isn't just bad luck. It is a systematic failure of two massive government bureaucracies that completely refuse to talk to each other. And guess who ends up paying the ultimate price for their silent treatment? When Richard applied for his Social Security benefits at age 66 and a half, he fell victim to a devastatingly quiet rule. It's buried deep inside the Social Security Administration's playbook, known as POMS HI000801.130. Sounds like a broken droid from Star Wars, right? But it's way more dangerous. Let me translate that government gibberish into plain English for you. By federal law, when you apply for Social Security after age 65, the government does something incredibly sneaky. They automatically and retroactively enroll you in Medicare Part A, and they force backdate that enrollment for up to 6 whole months. You don't get a choice in this. You don't get a little checkbox to opt out, and nobody calls to ask for your permission. It is a mandatory, non-negotiable 6-month retroactive look back. Now, why is that tiny administrative detail so catastrophically bad? Enter Internal Revenue Code. Section 223B(7). This is the hard, unforgiving tax law, and you need to write that number down right now. Section 223B(7) explicitly states that the absolute second you are enrolled in Medicare, any part of it, you are legally disqualified from contributing a single dime to an HSA. Because the Social Security Administration forcibly backdated Richard's Medicare Part A by 6 months, his timeline imploded. Every single dollar he and his employer deposited into his HSA during those last 6 months instantly mutated. They went from tax-deductible contributions straight into excess contributions. Richard just broke federal tax law without doing a single thing wrong. And let me be real with you. The IRS does not forgive, and they definitely do not forget. This triggers the first brutal penalty, a massive 6% excise, tax on the exact excess amount. You might be thinking, look, 6%? That's annoying, but it's not the end of the world. Listen to me carefully. This is not a one-time slap on the wrist, like a bad parking ticket. This is a compounding, blood-sucking phantom tax. The IRS is going to hit you with that 6% penalty on Form 5329 every single year, indefinitely. It keeps bleeding your account dry until you figure out the mistake and physically rip the money out. But here's the craziest part. Richard has absolutely zero clue this is happening. The IRS doesn't text you a heads up. They sit back in the shadows and wait for tax season, or worse, an audit. When Richard finally realizes he owes thousands in back taxes and compounding penalties, absolute panic sets in. And that panic forces him into the fatal move that knocks over the second domino. Richard's accountant hits him with the bad news. He needs cash immediately to pay the IRS penalties, cover the back taxes, and keep the lights on while they sort out this bureaucratic nightmare. Since his cash is tied up, Richard does what 90% of retirees do. He logs into his brokerage account and requests a quick lump sum distribution from his traditional IRA. He pulls out 40 grand. He thinks, hey, it's my money. I'll just pay the ordinary income tax, problem solved. Wrong. He didn't solve the problem. He just multiplied it by 10. By ripping that $40,000 out of his pre-tax IRA, Richard just artificially spiked his modified adjusted gross income, or MAGI. He basically painted a giant target on his own back and walked straight into the jaws of Title 42. Welcome to the infamous IRMAA trap. Ever heard of it? IRMAA stands for Income-Related Monthly Adjustment Amount. It is a stealth tax wearing a trench coat, cleverly disguised as a simple Medicare premium surcharge. But here's the ultimate catch. The government looks at your tax returns from 2 years ago to calculate today's premiums. Fast forward 2 years. Richard is now 68. He walks to his mailbox, opens a totally normal-looking letter from the SSA, and instantly feels his stomach hit the floor. Because of that $40,000 IRA withdrawal he made, his income breached the IRMAA threshold, and his premiums didn't just go up. His Medicare, Part B and Part D premiums have literally doubled. But wait, it actually gets worse. Medicare premiums aren't a bill you pay online. They are deducted directly from your Social Security check before you even see the money. Richard's monthly financial lifeline is suddenly decimated. The government is legally siphoning his Social Security to pay for the IRMAA surcharge, which was triggered by the IRA withdrawal, which was triggered by the HSA mistake. Are you starting to see the chain reaction yet? But the federal government isn't done playing games with Richard's life savings. Now, Richard is desperate. His cash flow is crushed. Let's fast forward a few years to age 73. He's stressed out, totally confused by his shrinking Social Security checks, and desperately trying to manage his dwindling accounts. In all this chaotic mess, he makes one fatal math error. He miscalculates his required minimum distribution, or RMD, from his old 401k. Under the ruthless new Secure Act 2.0, if you fail to take your exact RMD amount on time, the IRS unleashes Section 4974. A brutal, unforgiving 25% wealth confiscation penalty on the money you didn't withdraw. Let this sink in for a second. Because Richard worked an extra year and tried to save a few $1,000s in his HSA, he triggered a complete financial apocalypse. He suffered a 6% compounding tax, a spiked MAGI, a doubled premium, a slashed Social Security check, and a 25% penalty on his retirement account. This is not some theoretical scenario they teach in finance class. This exact sequence is playing out in living rooms across America right now, destroying nest eggs. The system is rigged to capitalize on your ignorance. But you don't have to be a victim, because I am going to show you exactly how to hack the sequence. This is the absolute most important part of this entire masterclass. If you are in your 60s, you need to memorize this master rescue plan right now. Execution is everything, and the sequence of how you execute is the difference between total salvation and financial ruin. Do not do step 3 before step 1, or you're gonna get burned. Step 1, the 6-month severance rule. If you are over 65, still working and actively contributing to an HSA, you must aggressively stop all contributions, both yours and your employers. And you have to do this exactly 6 months before the month you plan to apply for Social Security. Do not wait until the month you actually retire. That is a massive rookie mistake. If you plan to retire in December, your HSA must be completely shut down to 0 contributions by June. You absolutely must outsmart the 6-month retroactive lookback before it even happens. Step 2, the surgical extraction. Let's say you're watching this right now and feeling sick to your stomach because you realize you're already caught in the trap. You've already made those illegal excess contributions. So what the hell do you do? First of all, take a deep breath. Do not panic, and absolutely do not pull money randomly from your IRA like Richard did. You must contact your HSA custodian immediately and request a very specific transaction. Do not ask for a regular withdrawal, or the IRS will tax you again. You must explicitly tell them on the phone that you are executing a withdrawal of excess contributions. This highly specific phrasing ensures the custodian codes the distribution correctly to the IRS. You must remove the excess funds plus any earnings they made before the tax deadline. If you pull this off correctly, you completely neutralize that 6% compounding phantom tax. Poof, gone like it never happened. But let's move to step 3, the IRMAA appeal protocol. What if the dominoes have already crashed down? What if you already got that terrifying IRMAA, notice jacking up your Medicare premiums to the moon? Do not just roll over and accept it. The government definitely doesn't advertise this on billboards, but you can actually fight it and win. You need to download and file Form SSA 44. This is the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event form. Yeah, it's a massive mouthful. You are going to go to that form and check the specific box for work reduction or work stoppage. You will submit this directly to the Social Security Administration along with your proof. You're legally proving that the income spike was a one-time anomaly caused by retirement and correcting a tax error, and that your current income is drastically lower. If they approve it, they will wipe out the IRMAA surcharge and restore your Social Security check to its full power. Step 4, the RMD waiver request. If all this chaotic bureaucratic mess caused you to miss your RMD and face that brutal 25% Secure Act penalty, there is a secret backdoor the IRS really doesn't want you to know about. You will file IRS Form 5329. But listen to me very carefully. You are not going to send them a check for the penalty up front. Instead, you will pay the regular tax on the late RMD and attach a formal letter of explanation. In this letter, you are officially requesting a penalty waiver due to reasonable cause. You will explain that the complex cascade of retroactive Medicare enrollment and HSA excess correction caused an administrative error. And you must make sure to highlight that you have now fully rectified the issue. Believe it or not, the IRS is surprisingly lenient on first-time RMD waivers if you follow this exact polite procedure to the letter. Look at what we just uncovered together today. You have the Social Security Administration operating on one set of rules, automatically backdating your enrollment. Then you have the IRS operating on a completely different set of rules, waiting in the shadows to penalize you. And neither of these massive bureaucratic machines talks to the other. They don't warn you. They don't send you a friendly pop-up notification saying, "Hey, wait, your HSA is gonna blow up." The systemic, ugly truth is that the federal tax and retirement system is not designed to protect you. It is designed to process you. And when you deviate even slightly from their invisible code, you become a massive revenue source. Your financial advisor probably doesn't know this exact sequence. Your HR department definitely doesn't know it. The only person who is going to protect your hard-earned wealth is you. You have to arm yourself with the law, with the forms, and with the exact tactical strategies we just laid out. If you found this masterclass eye-opening, I need you to do a massive favor for me. Do not let this video die in the algorithm. Share this right now. Text the link to your brother, your sister, your parents, or your coworkers in their 60s. You could literally be saving them tens of thousands of dollars and years of bureaucratic nightmare with a single click. Hit that subscribe button and turn on the bell notification right now. Because on this channel, we don't do superficial financial fluff. We expose the traps, we decode the laws, and we give you the ultimate tactical advantage. I'll see you in the next one.